and we turn to the whole idea of stock market efficiency. So, if markets are efficient, investors can buy and sell stocks and be confident that they're getting good prices. But if markets are inefficient, then investors would be afraid to invest, and this would lead to a poor allocation of capital, and economic stagnation could even occur. So, from an economic standpoint, market efficiency is very good. So, there's an efficiency continuum, which you see on your slide, with the market for some companies' stocks being highly efficient, and that for other stocks it's highly inefficient. The key factor is the size of the company. The larger the firm, the more analysts tend to follow it, and thus the faster new information is likely to be reflected in the stock's price. Also, different companies communicate better with analysts and investors generally, and the better the communications, the more efficient the market for the stock. For very small companies that are more startup or they're just not well known, not many people are looking at them, and so they may be severely underpriced relative to their true intrinsic value. So you could get a good deal by buying one of these stocks. Now, you could also make a horrible mistake and buy a small stock, and it could go down and you could lose all your money. So market efficiency just means, how well and how quickly is the information about a stock incorporated into its stock price. If it's incorporated really quickly, then there's really hardly any way for you to hear some news about the company and immediately buy the stock. By the time you log into your account, the price will already have reflected that news, whether it was good or bad. So let's look at an example. You hear in the news that a medical research company received FDA approval for one of its products. And this is kind of sad because this reminds me of a stock that I bought. But there are some differences. If the market is highly efficient, can you expect to take advantage of this information by purchasing the stock? So if it's highly efficient, then that information will already be incorporated into that company's stock price. So there's no way she can get to push the button in time, to buy this stock and make a capital gain. Now for me, I had a stock, it was called PVCT, which we could look at because it would be interesting to look at and see if it's still here. Okay, yeah, it's still selling for 76 cents. And let me get the last 2 years of data. So it got this type of approval is for treating skin cancer. And let's look at the price. So I pretty much bought the stock when it was in this 285, 293 range to the, let's see if we can get that top point, to the $4 range. So, and I even told my dad it was a great investment, so he bought it too. So just realize that everyone can make mistakes. This was my one mistake for stock investing. And then you can see that there's a very sad and dramatic fall downwards because stuff came out about the company saying that basically the news that they gave and the reports that they gave were not totally accurate, and now there are all these lawsuits about people that lost all their money in the stock. I just put a little bit of money, so at least I did not lose a lot. Let's see if it goes down to see some of the news. No, it's been such a while that that news about the lawsuits isn't always streaming down here in the recent articles. So anyways, you can see it was like trading along here, and if I could have just bought it here at 83 cents and then sold it at $5.22, I could have made a lot of money, but I had no idea what it was going to do, and ultimately it failed for me. Now I can say a success story is when I invested in Apple. I bought it for $93 and I sold it for maybe $350. So that gain more than overtook the loss I incurred on this stock. So let's go back now that I got to reminisce. Okay, where am I going? PowerPoint. Okay, so there's really no way you can get into a stock quickly enough if it's a highly efficient market. And then looking at a small investor who has been reading about a hot IPO that is scheduled to go public later this week. And she wants to buy as many shares as she can and is planning on buying a lot of shares the first day once the stock begins trading. Would you advise her to do this? Well, not all initial public offerings are well received. And even if you were able to identify a quote hot issue, it is often difficult to purchase shares in the initial offering. These deals are generally oversubscribed, which means that the demand for shares at the offering price exceeds the number of shares issued, so you can't get in. In such instances where they're oversubscribed, investment bankers favor large institutional investors, who are their best customers, by the way, and small investors like me or this girl in the PowerPoint would find it hard, if not impossible, to get in on the ground floor. She can purchase the stock in the aftermarket, but evidence suggests that if you do not get in on the ground floor, the average IPO underperforms the overall market over the long run. For another question we could look at is, how does behavioral finance explain the real-world inconsistencies to the efficient markets hypothesis? Because a lot of times we look at research, or I do, and it shows that markets are efficient and that you can't make an abnormal return by using a certain strategy. Well, behavioral finance borrows from psychology to better understand how irrational behavior can be sustained over time. And what happens is it's often difficult for traders to take advantage of mispriced assets. And in addition to that, experiments indicate that investors and managers behave differently in down markets than they do in up markets. Also, individuals tend to overestimate their true abilities. This is called overconfidence, and it could be because of two other biases: self-attribution bias and hindsight bias. Self-attribution bias refers to people's tendency to believe that any success they have in an activity is due to their own talents, while they blame failure on bad luck rather than on their own stupidness. And then hindsight bias is the tendency of people to believe, after an event has occurred, that they predicted it before it actually happened. And so this is just a small taste of behavioral finance, and this is the end of the Chapter 2 PowerPoint presentation.